Massachusetts is Sam Burns. He is the founder and chief strategist at Mill Street Research. Welcome to TRT World. Tell us, what does the Fed's decision signal about its view, its confidence or lack of confidence in the current financial and banking turmoil we're seeing?
I think what they're trying to project now is sort of a difficult, messaging issue. They want to make sure that they're still fighting inflation, but also want to support the banking system and make sure that people understand that they're not going to cause further, distress or damage to the banking system by excessive monetary tightening. So they're walking a bit of a fine line right now. And I think that today's decision was mostly about trying to keep things, as close to normal and as close to what people were expecting as possible. So the 25 basis point rate increase and the decision about what their process for their balance sheet will remain unchanged. Their projections for future interest rates were roughly unchanged. I think they're trying to keep the message to be stability, and that they can fight the banking issues separately from the inflation issues.
And how have markets reacted, and will this decision by the Fed calm the financial and banking turmoil we've been seeing?
I think the Fed's decision was actually received relatively well initially. Stock prices today fell after the events, in large part, I think, because Janet Yellen was also testifying today to Congress and indicated that extended deposit insurance for the banks, particularly the smaller ones, that had been discussed in many quarters as a potential, benefit to a lot of the smaller banks, was not really under consideration. And so I think that having that prospect removed, at least, in theory for right now, caused a lot of sentiment shift toward those banks and caused the stock prices to sell off towards the end of the day. So it was two events occurred today, the Fed and Janet Yellen speaking. I think the Fed was actually viewed somewhat positively, but Janet Yellen's comments were viewed more negatively and had a bigger effect.
The turmoil we've been seeing in the past few weeks really has echoes of the financial crisis of 2008. And of course, we're an international channel. We've just been reporting there on the situation, the chaos in Lebanon. How much is what happens in the US right now and these decisions going to impact global markets and economies?
Well, you're right. Yeah, the U.S. tends to set the benchmark for a lot of global interest rates and currency influences, and they're certainly aware of that. I think their decision to increase their swap lines, their ability to lend dollars to other central banks, was in some ways a response to concern that certainly in Europe, some of the banks were starting to get people were getting nervous about them with Credit Suisse, and that's going to extend globally. That any banks globally that might start to come under pressure, the central banks might be able to get the dollars they need, at least in the short run, from the Fed, and that should help. Now, situations that are as dire as those there in Lebanon are more difficult and probably somewhat farther removed from what the Fed can do, or central banks in general can do. But I think overall the Fed is becoming more aware of the impacts of their interest rate increases globally, and are probably going to start to consider slowing them down, if not stopping them, within the next few months, in part for that reason.
Sam Burns, thank you so much for speaking to us today on TRT World, founder and chief strategist at Mill Street Research. Thank you. Really appreciate it.
Pleasure.